So how long have you worked for Scale?
A little over 4 years now, so I'm entering my 5th year.
Yeah, and now you're VP, right?
Yes.
And so you're doing this thing of like looking at all the companies that are coming in and helping us kind of, I guess, figure out what to invest in and what not to invest in. So on an average year, what does that look like? For like VCs like Scale, it's like hundreds, thousand companies, kind of that you look at in some way, shape, or form.
That's right.
Then
That's right. We typically look at hundreds of companies, and then we do deep dives into maybe tens, depending on the year.
And so, at that stage, this is a place where, maybe they're on the second meeting and you're asking to see financials. You're like, what does that look like internally? And so I've always wondered from the outside, like, what do you actually do during that phase? Because all I get is the partners telling me, like, you're great, we'd love to invest in you. Let's just look at what's happening inside, right?
Send
so what
us all
happens?
your data. That's right. So typically what we're looking for in terms of financials is we want to make sure you have product market fit. And there are typically a couple of metrics we look for. So the first I would say is we like to make sure that there is ARR growth, meaning if you're looking at ARR for the last maybe like 8 quarters, we want to make sure that net new ARR is growing over time. So like you want to see a curve like this, right? Yeah, that's usually a very good sign. There's a lot of demand for your product, a lot of interest, so your company is growing very quickly.
So that's kind of people's annual recurring revenue, right? That you want to see. And what's like a rough benchmark? Like what's kind of really bad territory and what's like really amazing territory as far as you're concerned?
Yeah, that's a good question. I would say you want to make sure your net new ARR increases over time. So let's say like you had 10,000 net new ARR last quarter. The next quarter after that, you want to make sure you add 20, and then the quarter after that, like maybe 40 or 50. Like you just want to show that there's a trajectory of growth.
Right.
Yeah.
And so that makes a lot of sense. And again, this idea that it's kind of the first thing to look at, because if you have sales momentum, that buys you so much freedom in terms of like a bad quarter or a bad hire, or any number of things that might happen. If you have that sales momentum, you can afford to do a lot of mistakes. So what are some of the other things you look at?
So the other thing I think is very important for SaaS businesses is making sure there's good sales efficiency. So for us, our metric is looking at the magic number. And what the magic number does is it looks at, so based off of your sales and marketing spend for the last quarter, what new revenue are you adding for the next quarter?
Okay.
So there's kind of this like, fine balance between what you spend in terms of sales and marketing and what new revenue you're generating. So that also ties into ARR, of course, too, because that's the bookings portion of it. Typically, we like to see magic numbers of 1.
So what would that mean, like intuitively?
Sure. One is, so like if you spent $1 in sales and marketing, you want to generate almost $1 in revenue. If the company is ramping very quickly, as in they're investing more in sales and marketing spend, this will often come down. But like, it's something that we expect as you grow. But typically we like to see 1 when we invest. And that's the metric that we look for.
So again, it's this sense of growth and trajectory. So you're not worried just about...
not spending too much money. So that's where the sales efficiency number comes in. Is you have this growth, but you're not overspending for it. Like it comes a little bit more naturally.
So let's dive into sales efficiency. Like how do you measure that, and what's kind of a good benchmark for that usually?
Sure. So like I mentioned, like the magic number is one way that we track it. Generally, we want it to be 1 and just keep it around there if you can.
Okay, that makes sense.
Yeah.
So what are some of the other things you look at?
Sure. I think our top 2 really is like the ARR growth and then the magic number, the sales efficiency. We also look at gross margin. So you want to make sure you're in line with other SaaS companies. So typically around 60-70%. You want to make sure that, your COGS are not out of control because, it is very important to make sure you have enough cash because, if you don't have cash, then you're basically going to go out of business, and nobody wants that to happen. Yeah.
So this idea that if you're really not able to capture like a margin on your current pricing now, it's unlikely to change in the future, right? And you got to stay within a certain benchmark to kind of have a kind of a good business. And so in long term, I think there's also something that maybe isn't telling so much about the health of the company, but is important to VC, which is like your potential returns as well, right? So is that something you also look at when you look at company?
We definitely look at potential return, and the return part is a little bit tricky, right? Because we look at a whole bunch of different factors for this. So financial is only one aspect of it. We also look at market size and all that. So essentially what we're looking for is how big can your company become? And based off of that, like what can we potentially make on the company? So generally, the higher return, the better. But it depends on stage. So if you're investing in a more early stage company, then the return, we expect it to be a lot higher. If the company is more later stage, then we expect the return to be a little bit lower.
Right.
And we like to have a balance in terms of like having a certain number of early stage companies and then a certain number of late stage companies.
Right. So that could be a financial consideration that's really, not saying much at all about your company's health, but might lead a VC from passing on a deal just because they're not going to get a big enough outcome.
Right.
Out
If you
of
feel like you're not going to get a big enough outcome and you have like this model that you have for your fund and it doesn't fit, then most likely the VC won't invest.
Right.
Yeah.
But it could be that another VC or another financial institution of some sort would take that deal because you're performing well and they don't have as high of expectation in terms of the return they're going to make on the overall investment. Are there any other things, any other consideration that come in, any other metrics you look at?
I would also look at cash because like when we invest in a company, we want to make sure you don't spend too much because again, like you don't want the business to go or you don't want the company to go out of business. And if you run out of cash, then you're out of business. For SaaS companies, you have to invest money to make money. So we want to make sure when we invest in companies that the cash will last them at least 2 years. Yeah, so generally that's why we spend so much time looking at your sales efficiency metrics is we want to make, and your gross margins too, is to make sure that you won't run out of cash.
Sure. So what's kind of the idea of like 2 years versus like a year, or like I know companies have different kind of mental models about that.
I think that's a very good question. Generally, we like to think of it in 2 years because if you can make the money last 2 years, you'll hopefully be at the company will hopefully be big enough where they can raise at a bigger valuation, and that's what we're kind of looking for. Right. A lot of companies, especially in the last couple of years, they've raised a little bit sooner, so they'll raise after a year. How often you can raise, it depends on a mixture of things, like the capital markets. So I would say funding came a little bit easier in the last couple of years. Right. Now it's getting a little bit more challenging, so the cash has to last a little bit longer. But if you're thinking about like how much you're going to spend for the next year because you're doing annual planning, this definitely should come into play. So if you think you're not going to be able to raise for another year, then you should probably spend a little bit less. But if you think you can raise money for the next or in the next year, then you can probably spend a little bit more and get higher growth.
Right. But otherwise, the prototypical kind of growth curve would be, you're able to take this influx of funds, right, and really grow your company and get to the next benchmark, the next order of magnitude in that 2 year period,
right. Yes,
and do another round, right?
That's
and
right.
some companies grow a lot faster and they're able to raise faster, and some of them never able to raise.
Yes,
but
that's right. If you're more capital efficient, then the cash will last you for even longer. And like we love finding companies that look like that.
Yeah, which is actually like a little bit atypical, right? I think a lot of people just would rather have you on that kind of curve and growing explosively and just keep getting new funding all the time.
That's right. I feel like the market has changed a little bit where a lot of VCs now value profitability, a path to profitability versus like the insanely high growth. Ideally, you can find companies that have both, but it is really rare. Generally, the companies that do have this have some sort of like virality.
Right.
So like there's some portion of it that can make it go viral. Most traditional SaaS businesses are just not like that. You have to invest money into sales and marketing and salespeople in order to drive the growth forward.
Right. Like they grow fast, but not like
not
Uber
like
or Airbnb fast.
exponentially. That's right. They're not consumer companies. They're different models after all.
Makes sense.
Yeah.
Anything else you feel like we should cover? Anything else that kind of goes through your mind when you review companies?
Yeah. I would say financial is just one aspect of it. Like we also take a lot of other things into consideration. At our stage, it is good to use financial metrics as a filter because we look at so many companies, right? And if you have more than $1 million ARR, then the financial metrics are a good way to gauge the health of the business. But at the same time, like we also take things like market size, team, et cetera, into consideration. So I would say financial metrics are important, but it's only one factor that we look at.
Okay. Is there like one like gigantic red flag or pet peeve when you get the data from company that makes you go like, no?
That's a good
like
question. I like to get the underlying data. So oftentimes we'll have people calculate metrics for us and present it to us that way. Sometimes I find that it might not be calculated correctly and I just want to get the raw data and then like figure it out myself. So if people were to send us data, I would prefer it if they just send us all the raw data and have us like just figure it out versus like calculate the magic number. I mean, I appreciate the effort though. Like it shows you did your homework.
Yeah. No, but now they know.
Yeah.
Thank you so much.
Thanks.